I'm Ron DeLegge with ETF Guide. Great to see you again. And if you've been enjoying our channel, welcome aboard. Be sure to subscribe and tell your 10 million friends. I got some charts I want to share with you on today's episode, so let's get right to it. On our community tab, we did a poll. I asked you, what is your preferred style of stock market investing? And according to this poll, the vast majority favor dividends and income, with just over 42% actually saying that. Then we had growth stocks right behind, and then value stocks. We also had some really good comments in the just below this poll. We had Joanne, a regular. She likes the super high yield dividends and income. And I'm going to guess probably some of those leverage and maybe even single stock high income ETFs are probably right up her wheelhouse. We had Guaya Kill Hook, who likes to not only get dividends, but compound them by reinvesting them. Jeppy as well, JEPQ are among his favorite ETFs. Roman likes all of these strategies, but he likes to emphasize growth stocks in his portfolio. And then we also had Marcel weighing in, saying sector ETFs are among his favorite. And sector ETFs, by the way, are one of the biggest ETF categories. Lots of fun choices. They also allow you to customize your exposure to the stock market. So instead of going with, let's say, a broad index fund where the sectors are set for you, going with an individual sector ETF or multiple sector ETFs allows you to overweight certain areas of the market that you may be more favorable on versus just a generic broad approach. Boss Ball Head Dog, one of my favorite viewers, asked, where have you been, Ron? Well, I'm right here. I'm not going to abandon you. But yes, I've been away a little bit, and I have been focusing on some things behind the scenes that I'm going to be announcing for our viewers that I'm really excited about. That's been taking up some of my time. Also, I took about a week off for vacation, went to Europe. What a beautiful place. And so, but I'm here. I'm not going to abandon you, boss, or abandon anyone else. Let's take a look at see where major indexes and markets are. We've got S&P 500 up just over 24% since the start of the year. This is a year-to-date performance chart. So that means, again, it's from January 1st through the market close of October 18th. Been a great year for S&P 500. Going to give you some historical context on this lights out performance in a second. You can see in the pink, the hot pink, is Bitcoin, which you see all those jigs and jags. It looks kind of like a Mount Everest with the peaks and the valleys. Well, it's been mostly upward peaks. It's been trending higher, up 61% since the start of the year. That is Bitcoin itself. And some of the other major asset classes also performing strongly. We've got commodities, SDCI, as well as global real estate up double digits. Bonds, BND, up just a nudge over 3%. And so that's your big picture view and a comparison of the major asset classes versus each other and some of the ETFs tracking them. Now, in terms of Bitcoin itself, this takes a look at spot Bitcoin ETF, one of them, IBIT, which was introduced in late January. And so it didn't capture or hasn't captured the full 2024 performance of Bitcoin itself, but it has captured almost 40% of Bitcoin's year-to-date performance, which is quite impressive. So IBIT is one of those spot Bitcoin ETFs, again, that was launched earlier this year. Also big news, those of you that trade options, call and put options, they were approved on spot Bitcoin ETFs, and that is big news. That just happened this week. Securities Exchange Commission finally approving call and put options on spot Bitcoin ETFs. So check your brokerage dashboards, whoever your favorite broker dealer is, you will see that start to populate in the coming weeks if you're into options on spot Bitcoin ETFs. Now, in terms of historical context, where are we at? How does 2024, as good as it has been, and we've got major stock benchmarks from the S&P 500 to the Dow at all-time highs, and they've continued to do that, just continue to pound higher and higher and higher. And if we take a look at how this compares to previous years, this goes back to 1928, and we are at the 13th best year. S&P 500, first 197 days of the year, we're 13th best. Of course, you can see highlighted in gray, that gray line. We don't know how it's going to end, but so far it's been pretty darn good. Look at 1929. That's line number 8. It started out gaining over 26%, and then it crashed 30%. What a crazy year that was. And it actually ended down for the year about 12%. So you can see that stocks can do anything at any moment. And although we are obviously in different times, stock market trading is not like it was 100 years ago. It's become highly digitized. Nevertheless, it's public sentiment and public psychology that drives stock market prices. It's not algorithms. It's not dividend yields. It's not trading volume. It's not none of that. It's not PE ratios. It's psychology that drives stock prices. And if psychology is good or positive like it is right now, then what are you going to see? Stock prices are going to be up. If it's negative, then prices are going to be down. This is a snapshot of what's going on in terms of S&P 500 industry sectors. There's 11. And I like to slice them up in terms of like a pizza. I'm from Chicago originally, so I favor, those Chicago deep dish pizzas. But hey, I'm a fan of New York pizza too. I can eat any kind of pizza as long as that crust is crunchy and good and has a good base to it with some nice tomato sauce. And if you take a look at these 11 industry groups, the top 3 performers: utilities, financials, and communication services. What's interesting is 2 of these top 3 sectors are heavily influenced by interest rates and impacted by interest rates. We see the Federal Reserve starting to ease interest rates with the expectation that they will continue to go down. That's been good for utilities and financials. But everything from offensive to defensive industry groups, all up, and all up strongly, double digits. That's very, very bullish. Nothing bearish here in terms of market performance so far in 2024. If we take a look at stocks globally, again, bullish across the board. There's only really one region that's down, and that's South America. Everywhere else is up. Take a look at China, GXC, which is up almost 20%. Chinese stocks getting a massive pop to the upside. For most of the year, they were flat, but they've seen a pop up here because of that announcement of economic stimulus by the PBOC. That's the People Bank of China. And so we're going to have to see if that sticks. But so far, traders like what they're seeing and hearing from the PBOC, and that's boosted Chinese stocks. In terms of some other areas that I want to point your attention to that I think merit your attention, this is uranium. And I don't know if you've been paying attention, but 3 tech titans, Amazon, Microsoft, and Google, announced plans to get into the nuclear sector. Well, why are they doing this, Ron? Because they need energy. They need energy to power these massive AI data centers. And where are they going to get it from? Well, they're going to get it from the nuclear sector. What powers nuclear power is uranium. That's what's required. That's the fuel for all of these nuclear power plants. And so uranium has been all over the place this year. You can see it since its bottom in the summer. It's really had a sharp pop. And URAA aims for leveraged exposure to uranium. We've got URNM and URNJ, which are both unleveraged. URNJ is a small cap miners. URNM is just to the regular uranium miners. But you also have some pure uranium exposure mixed in with exposure to those uranium stocks. So put all of these ETFs on your radar. This is a major mega theme as we get to shifting away from fossil fuels. Nuclear energy is making a resurgence. Uranium is going to be right in that mix. It's going to be a high in demand mineral, critical mineral, that's going to play a major role in that shift and that resurgence of nuclear energy. And we're going to be talking more about this in an upcoming episode of Shifting Energy with Sprott. So stay tuned for that. That should be released here in the next week or two, and we'll talk extensively about that. I wanted to highlight some of the single stock ETFs. This takes a look at NVIDIA. Since the start of the year, NVIDIA itself has gained almost 179%. But take a look at this. NVDU, which aims for 2x or 200% daily leverage to NVIDIA's stock, NVDU has gained over 333%. Why is that? How is it able to do much better than NVIDIA itself? Well, because it uses leverage, 200% daily leverage. So that means if NVIDIA on any given day goes up 1%, NVDU by design should be up 2%. And that works to the downside too. So if NVIDIA crashes 2%, then NVDU is going to be down 4%. But again, these single stock ETFs have been vacuuming in lots of money. It allows you to take a tactical position to any individual stocks that you may be on your radar. And so NVIDIA is just one of many. This is from Direction. They've got a series of single stock ETFs tied to Mag 7 stocks. So check them out at Direction. And also, just from a portfolio building perspective, where does this fit in? If I'm going to use a single stock ETF, it's going to go into the non-core portfolio in the DeLegge framework, right? There's three portions of a portfolio. You got your core, your non-core, and then your margin of safety. So single stock ETFs go into the non-core portion of the portfolio where you can be a little bit more tactical and take higher risk. So what's the big money doing? How did they make that money? Where did they make their fortune? Well, take a look at the top 15 billionaires. It's technology. And this is a good lesson, I think, for investors, is to position and orientate that portfolio more towards technology. That's where it's at. Digitization, AI, cloud computing, cybersecurity, all of that is becoming a bigger and bigger part of people's net worth. And so I think from a portfolio construction perspective, that is definitely the smart way to go. Now, in terms of the U.S. presidential election, who's going to win? Well, according to Polymarket, we've got DONN versus comma, KAMA, and right now it's DONN. I just made up these ticker symbols just out of the blue. But you can see the chart here. The blue represents Kamala Harris, the red Donald Trump. 60% think Trump's going to win, 40% thinks Kamala Harris is going to win. And I would say this is a lot more accurate than any polls out there because there's $2 billion of wagers riding on this outcome. And so this, again, is just one perspective, one look at what bettors and wagers think about what's going to happen with the U.S. presidential election outcome. Now, it doesn't matter who wins because there's still massive problems facing the U.S. government in terms of its fiscal health that aren't going to be quickly resolved. We've got runaway spending, as you can see from this chart, and revenues that aren't keeping up with all of that spending. And it's increasing the debt load of the U.S. government, and there's a structural mismatch, as you can see here, from what they're taking in versus what they're spending. Simply put, it's creating deficits because they're spending far more than they're taking in. And so this is a massive problem. You can see this highlighted just from looking at last year's federal spending versus revenue. They only took in $4.4 trillion. They spent $6.1 trillion. And again, if you do this on an annual basis consistently, as the U.S. government has been doing, it's going to create lots and lots of debt. It's going to create lots and lots of deficits, and that compounds negatively. That's called negative compounding, and it's adding up, and it's creating big, big problems for the government, and that means higher taxes for all of us, and I want to connect the dots on this. This is why I included this in today's video. But this just takes a look at the next 10 years. Where is all that money going, right? If we got runaway spending, where is it going? Well, these three areas are eating or devouring most of that money. It's interest costs and all that debt, Social Security, and Medicare. And this is why David Walker, former comptroller of the U.S. government, he's written several excellent books. His latest is called America 2040. He says that tax rates, and I agree with him, are the lowest they're ever going to go in going to be in our lifetime, and they're going up, and they're going up significantly. So think about that for a second. If future tax rates are going up significantly in the future, that means those of us watching, along with myself, when we retire, there's a higher than better possibility, very good possibility, we're going to be in a higher tax bracket in retirement, which is interesting because you have a lot of so-called financial gurus telling you the exact opposite, that you're going to be in a lower tax bracket in retirement because you're earning less money. But not the case. If tax rates dramatically go higher, even though you're earning less money, you could be in a higher tax bracket and paying higher taxes in retirement. And so this is the problem facing all of us. And most Americans, unfortunately, have the bulk of their money tied up in the taxable and tax-deferred bucket. I refer to that as the tax me now bucket. That's taxable. A taxable tax-deferred bucket is the tax me later bucket. So these two buckets do not protect you or hedge you against future tax rate increases. And this is where the bulk of most Americans have their money stored, have their net worth stored. And that's a problem in a rising tax rate environment. Not nearly enough in the gray bucket, which is the tax-free bucket. And so what is the solution? How do you solve this problem? Well, the solution is by shifting money into the tax-free zone. And you want to do it while U.S. tax rates are still near 50-year lows, which they are right now. And they'll be that way until next year. And then you're going to have an expiration of the current tax law. It'll become something else. But take advantage. Don't let 2024 pass by without shifting some of your money from your taxable and tax-deferred bucket into the tax-free zone. And for some of you, that may mean doing a Roth IRA conversion. For some of you, it may mean doing Roth IRA contributions. For others, it may mean doing a Roth 401k contribution, right? These are some examples of ways to get that money. Pay the taxes now while tax rates are at 50-year lows, and get it out of the way and protect that money forever from the threat of higher tax rates. And so, again, these are some of the financial icebergs. We've talked a lot on this program so far about investment positioning, right? But what about asset positioning from a tax perspective? You got to have both. You can't just have great investment positioning, but then poor tax positioning. You got to have both to have a great outcome. And these are some of the financial icebergs that we face. Not just inflation, not just accidents or illness or market crashes, but also the threat of higher taxes. And so maybe there's an imbalance in your portfolio. Maybe it's a problem that you're not even aware of. Well, I'm bringing this to your attention right now, and reach out to me. Maybe you're a candidate for a portfolio makeover, and we can talk about it. Hit the description section below, and we'll feature your portfolio. Of course, anonymously. We won't feature your identity, not unless you want that. But we'll take a look at it together and get to the bottom of it and see if you're positioned correctly, not just from an investment perspective, but also from a tax perspective. Well, that does it for today's episode. I hope you've enjoyed it. Hit the comment section below and let me know. And hit the like button. I'm Ron DeLegge with ETF Guide. We'll hit you up and catch you on the next episode. Thanks for watching.